Welcome, everybody. Today, we're going to talk about how to analyze an apartment complex deal, no matter what the deal is. And I'm going to go step by step. Okay. The first 4 steps are going to be all about how to find out what its actual value is or could be. And then the next 2 steps are going to discuss how much money this apartment complex can make for you and your investors. All right, so let's kick it. Now, for all the Marines out there, I want you to know that this is not that complicated. Okay, it can be complex because there's maybe multiple units, right? Many apartments in an apartment complex, and you want to take all of them into account ultimately. But the actual, if you step back, 10,000 foot view is not that complex. And I'm going to break it down. And then the 4th step we're going to talk about, it'll be the big light bulb moment. This is the thing that made me almost stop my car when I was driving down 146 from Miramar in San Diego. Okay, this will make a lot of sense as long as you don't overcomplicate it yourself. All right. So let's go into step number 1. Step number 1 is determine the total revenue over the last 12 months. Okay. This typically is just rents, but sometimes there's other things that you might be able to charge people for, like pet rents, administration fees, late fees. There's all sorts of things, right? You can even add additional little side hustles into the apartment complex if you want it to make more money than just the rents, right? So, but you have to get all this information over the last 12 months. Okay, that is what your T12 is, if you will. And a lot of lenders and a lot of people that are looking at properties might want to even look at T24, T36, meaning the trailing 12, 24, or 36 months is what you want to look at. Now, that is step number 1, right? Just know how much money, no kidding, it made in the last year, the last 12 months. So that's total revenue. Step number 2 is you need to find out the total expenses over the last 12 months. So what it actually costs to run this property, not including the debt service, meaning the loan, or any capital expenditures. I'll get into that later. That's how you determine how much money this actually puts into your pocket every month. But for now, we're trying to figure out the value. You just need to know how much it costs to actually run this business, all right, from a fixed cost perspective. So all of that needs to be determined, again, over the last 12 months. And if you want to get a really good picture and figure out the trend of the property and the surrounding area, then I would recommend also looking back as far as 3 years, like we said, T36 for trailing 36 months. But for the math, all you need is 1 year. Now, step number 3, you need to determine the NOI. Okay, all this is net operating income, which is just subtracting one from the other. So what is the total annual revenue minus the total annual expenses? And that's it. That number is your NOI. It's that simple. Now, I will say there's a lot of confusion with NOI because sometimes people consider it profit, which it's not. This is not the actual amount of money you put into your pocket. Sometimes people refer to this as revenue, even though it's not. The revenue was at the top, right? And you already subtracted all the expenses. And some people confuse this with cash flow. It's not cash flow. We'll talk about that here in a second. NOI is just simply how much money did the business produce minus how much money did it cost to run the business, period. Now, step number 4. Step number 4 is capitalization rate. So you need to do some math with a cap rate or a capitalization rate. And the easiest way to think about this, and I'm going to deep dive into this, okay? So just get ready to nerd out a little bit. The easiest way to think about this is that it's a multiple. And the reason is because it's a rate, okay? So it's a rate of change or transaction. In this case, at what rate do you sell these properties for, as far as how much will you pay for example, square footage, but in this case, how much money it makes. So it's all about how much money it makes. At what rate will you trade this property for money? And it's all based on how much money it makes. So cap rate is a percentage, okay? And if you divide by a percentage or any fraction that is less than 1, remember grade school math, it means that it's actually multiplying whatever you were dividing it by, right? So if you have 10 and you divide it by 0.1, it's actually like multiplying by 10, right? So 10 divided by 0.1, 10 divided by 10% is 100. And so capitalization rates are typically expressed in percentages. And so the lower the percentage, the higher the multiple. So for example, one of my properties is a 6.5% capitalization rate property. Like that's what the properties like it in that area trade for. They trade at a 6.5 cap, as sometimes you'll hear it be said. So what that means is it's about a little bit over a 15 multiple. So whatever the NOI is going to be affected by that. Now this is the math. It's simply take the NOI and divide it by the cap rate. Okay, so let's say the NOI is 100,000, meaning that the property had some sort of revenue, let's call it 200,000, and then it had, let's say, $100,000 worth of expenses to run the property, so minus 100,000. Now you're left with 100,000. That's your NOI, remember? And you divide it by the cap rate. So let's pretend, just for easy numbers, it's 10% or 0.1. If you divide 100,000 by 0.1, it's the same thing as multiplying by 10. So the multiple would be 10. So 100,000 times 10 equals $1 million. So in this case, the property is worth $1 million when you compare it apples to other properties in the area based off of the supply and demand in that area and all that kind of stuff, right? Not going to get into that quite yet, but we will here in a second. So what that means is now you know that whatever you do to the property, whether you increase its revenue or you decrease its expenses, the NOI will change, right? So your objective is to change the NOI, to grow that NOI, because then you'll be able to multiply the value by 10 every single time. Now, here's something crazy that'll end up happening. Sometimes if the area starts becoming more competitive, right, the supply and demand changes. Maybe the supply goes down, but the demand remained. Or maybe the supply remained, but the demand went up, right? All of a sudden, what happens is that property might be more desirable. And so people will be willing to pay a lower cap rate or a higher multiple on the property. So what could happen, this happened to my property. I had a property that went from a 9% to a 6.5% cap rate. But for easy math, we had this $100,000 NOI property. Let's say it was a 50-unit apartment complex that, let's say it was trading for a 10 cap, so its value was $1 million. Well, let's say that area became way more desirable, and now the cap rate went down. So people were willing to pay more for that property. And it's not only the area, it's that asset class. Like maybe people love apartment complexes that much more. And believe me, investors love apartment complexes because it's not only the business that you're buying, you're also buying the physical real estate. So there's a hedge there, not to mention it has the best tax breaks in the world. So I'm not going to get into that right now, but that is one big reason why a lot of investors are foaming at the mouth for good general partners, people that buy these apartment complexes, and they will help you buy it because they'll give you the money for it. And then they'll shut up and they'll sit back and they'll watch you do it. More on that later. Now, so when you decrease the cap rate because that asset became more desirable, that area became more desirable, whatever the case may be, it skyrockets the value. So if in this case, if the property's cap rate, that area, that asset class started trading for a 6.5% cap rate instead of a 10% cap rate, but the revenue minus expenses still stayed at $100,000, you now divide 100,000 by 6.5%, and that's the same thing as multiplying a little bit over 15 times. So let's just say for argument's sake, it's 15. So that would turn into a $1.5 million property. So just because the area basically became more desirable or the asset class became more desirable, all of a sudden the cap rate went down, which means the multiple went up, which means that property changed nothing to now is worth 50% more than it was. Okay. Now, here's where you get to be in the driver's seat. Let's say that this property, you increase the rents there by $50. So remember, I'm pretending that it's a 50-unit apartment complex. And obviously, it's not going to happen overnight, but just for the sake of the argument, let's say that you increase the rents across the board for every single unit. Maybe it took you 12 months to do so by $50. And let's say the expenses did not change at all, just for the sake of the argument. Over a 12-month period, remember, because the revenue is an annual thing and the expenses are an annual thing we're looking for. Let's say you took those $50 times 50 units, right, times 12 months, that is $30,000. And because the expenses didn't go up, it was just your revenue that went up. And so now revenue is $230,000, your expenses are $100,000. So now the NOI is $130,000, right? So that 30 just kind of trickled right down to the bottom line for the NOI. Now you do the same thing. You divide it by 6.5. Okay. So if it's divided by 6.5%, All right, so 0.065 really, right? It's actually like multiplying it by 15, but now we're multiplying 130,000 by 15 instead of 100,000. So now it's a grand total of a $2 million property. This property is valued $2 million. If you put it on the market, the idea is that there will be enough demand that you should be able to sell it for that price really without any issues. So those are the 4 steps for just determining the value, okay? We're gonna talk about money here in a second. How do you actually put money into your pocket, the cash flow, all that kind of stuff. But for now, let's just go over one more time. You need to find out total annual revenue minus total annual expenses equals the NOI, or the net operating income, and then you divide it by a percentage we call the capitalization rate. And that cap rate is determined by the supply and demand in that area. It is similar to, let's say, the price per square foot in single family investing, right? So when you look at a home on Zillow, you oftentimes look, okay, there's many similar homes like this in this neighborhood that sold recently. What was the average dollar amount per square foot? What was the cost per square foot, or the price per square foot? You check that out, and that'll give you a good idea of what yours would be valued if you had a little bit extra more square footage, right? That's how you do that math. So in this case, it's the cap rate. That cap rate becomes kind of like that price per square foot, except for it's price per money made, right? So how much money it makes, the NOI, becomes the number you really look at. And the beautiful thing is again, you're in control because you're treating it like a business and you're able to operate it how you think best. And if you increase the NOI, you will increase the value as long as the cap rate doesn't go up. You really do benefit greatly from it going down. If you buy in an area where you see stable job growth, the idea is that hopefully the supply and demand will work in your favor and that the cap rate will condense. It'll get crunched. Now, let's talk about part 2, how to actually make money and how this pays you and your investors every single month. There's 2 more steps you have to take into account. So the first thing in this part of the video is really step 5, if you will, is the loan. Okay, the loan is a combination, a lot of times, of principal and interest. So when you get a loan from the bank, let's say you got 80% of the price of the property loaned to you. So you only have to bring 20% as a down payment plus renovation costs, whatever you calculated into your numbers. That 80%, right, is what the bank gives you. Now you have to pay that off over a certain period of time. And so the amount that you actually pay off against the balance is called principal, and the amount you pay to the bank for just being able to borrow it in the first place is called, the interest that you pay, and that's based off of the interest rate. Might sound obvious, but I just want to make sure we go over that. You have to put the loan payment down on your numbers because you can't forget about that expense. It is not an expense that is required to run the property, right? The property will run just as well regardless of what the loan payment is in theory, right? Unless the loan payment's so high, then you can't, maybe you just can't even do regular maintenance. But the point is imagine a world where the loan payment doesn't exist. That doesn't actually affect how the property runs, right? And because interest rates change all the time, the argument is that you shouldn't count a property's value, against the loan. It does kind of affect the value and the price in a way because it is going to cause a trickle-down effect, right? If loan rates are so high that people just can't pay the same rate for the property, right, then it really kind of defeats the purpose of owning the property in the first place because it's not going to bring you the cash flow that you might want. And so it will probably slow down the market significantly, which will eventually maybe make the cap rates increase, which decreases the values of the properties. But I don't want to dive into that too deep right now. It's all interconnected, but when you're running the numbers, just know that the loan amount, the debt service, right? Like what you pay for the loan does not count against the value of the property. This is below the NOI, or below the line, if you will. So you put that in, right? So let's say the property was making 100,000. Let's use our previous example. And let's say the loan amount, and I'm just making numbers up just for the sake of this example. Let's say the loan amount was $5,000 a month. Okay, so total of $60,000 over the span of a year, right? All of this has to be annualized. So now you're left with $40,000 in cash flow. Or are you left with that? There's one more thing. There's one more thing you cannot forget. Absolutely cannot. And that is CapEx, or capital expenditures. This is a very confused term because It has to deal with taxes a lot of times. And you basically have to determine with your CPA, with your enrolled agent, with your accountant, with your finance team, whoever you do this stuff with, what is actually depreciable and what is an expense, something that you can deduct that same year. So if something you can deduct that same year, it's just some kind of small fix or ongoing maintenance with the property and its units, then you just write that off. You don't depreciate that. Depreciation just means you write it off over a span of years, right? And so those that you do not get to write off the same year is something that you depreciate. A lot of people say capitalize. And then what happens is you, like I said, you do it over a span of multiple years, maybe 7, 15, 20, it doesn't matter. For the sake of this example, it doesn't happen immediately. And it's considered something that improves the property. So capitalization expenses are something that should add value to the property or keep it at the value that you're advertising it to be, right? So it's not an expense that is actually required to run the business of the property, but it is to upkeep the physical structure, for example, okay? Now, I'm not a tax professional, I'm not a CPA, I'm not an attorney, I'm not a cost segregation expert. I'm just explaining to you how me, as a practitioner, as somebody who invests in real estate, how I think about this, okay? So if you have to then, let's say, do a bunch of structural work, or let's say, change all the gutters in the building, that might cost you, let's just pretend $10,000. So now that $40,000 really in cash flow that you thought you're going to put in your pocket, you're really only putting away $30,000 into your pocket as cash flow because you had to spend $10,000 on gutters. And so that's how all of this works, okay? That is the step 6. That is the last piece before you actually put money into your pocket. And a lot of people, they don't look at CapEx and they just assume that the property will live on forever. But the reality is you have to upkeep the structure to make sure the property is still standing so you can run the business in the first place, right? So next time you look at a property, make sure, promise me you're actually going to look at cap rate as well as cap X, right? The capitalization expenses are a huge deal. Okay. The capital expenses, I think I called them capitalization expenses earlier. I apologize. The capital expenditures, expenses, those actually have to be considered no matter what, if you're planning on making cash flow. Because if you look and you're like, oh, it's going to make $40,000 in a year, right? Spread out 12 months. And then you find out you have to change the roofs and that's going to cost you $40,000. Well, then you're actually making $0 in cash flow. Even though the property has a positive NOI and it might be worth millions of dollars, you could still potentially be putting zero money into your pocket. So let's talk about theory here. What do you actually do now that you're looking at a property? What do you actually do? Here's what I'll say. There's a lot of deal analyzers or underwriters, as we call them, that do not even look at cap rate at all almost. They look at it as a way to guide them on how, to talk to the brokers about this, what the pricing can or should be, but they don't look at it as something that is going to determine whether they do the deal or not. Oh, I got it for the going cap rate. No, it doesn't matter. Is it going to make you money? That's what matters. And so what you want to do is you want to actually go all the way through all of those steps, see what the cash flow is going to be, and then see if that cash flow is enough to pay your investors the returns that they want and to pay you, the person who's operating the property. If that checks out conservatively, you're good to go. That's how you will determine if this is actually going to cash flow. A lot of people, especially when everything got crazy over COVID, they really started biting off more than they could chew. They really started signing up for debt that was variable interest that when it was low and now put them, in a troubling spot because their cash flow got hit. The property still might be doing great as far as what its value would have been based off of NOI, but because the interest rates fluctuated or because they didn't calculate the capital expenses, it really started biting them in the butt. So again, if you're going to do this, you want to have yourself or somebody on your team be a very good underwriter. Here's how you build a team, by the way. Okay, so at ADPI, we're a military real estate investing community. If you don't know us, like and subscribe, whatever, all the things. But there's 4 different team members that we focus on, okay? So there's the deal acquisition specialist, also known as like the deal sourcer kind of, but we call them deal acquisition specialist. Then there's the underwriter or deal analyzer, what we're talking about right now. You have to be really good at that. And then there's also capital raiser. So these people are the ones that are in charge of making sure all the money comes in. Everybody's going to be raising capital on the team, or it's preferred to, but they're kind of in charge of that. And then they also take investor relations after closing to make sure the investors know what's up. And then 4th is the asset manager. This is somebody who executes the business model that the underwriter put together on spreadsheets of, hey, this is where we need to be at this point in time. This is how the renovations need to be. This is what the rents should be at, all that kind of stuff. So with this team of 4, this is how you actually find good deals. And then you raise the money for those deals. You manage those deals, and ultimately you make a heck of a lot of money. And if you're in the military, reservist, retiree, military spouse, veteran, whatever, and you're interested in this, if you want to build your own team and find somebody who's going to be an absolute expert at these numbers, or if you want to be that expert, then I highly recommend you apply for a cohort in one of the links below, or you just join our community and start learning from everyone else. There's calls that we go over deals all the time, so I highly recommend you join and you learn about this. This is what we do all day, every day. ADPI, or Active Duty Passive Income, is we're a military real estate investing education community, and our members have bought billions of dollars of real estate, and we're very proud of it. So hope to see you inside the community. If not, watch the next video. See you later. Bye.